So we're going to do quick study 16-3. That's found on page 664. And what we're going to do is we're going to use this information to decrease the company's cash flow from operating activities, to determine the company's cash flow from activities. So you start with the net income, 72,800. All right. So we're going to do the cash flow from operating activities. We're going to have the net income is where they start on that. And the net income was on the accrual basis, and it's 72,800. Now here's the adjustments. To reconcile net income to operating cash flow. Okay. So the first thing we're going to do is let's add back the depreciation. And the depreciation is an expense, it's $144. So we're going to add that back. It's $144. And the reason we're going to do that is because it's an expense on the accrual basis, right? However, there was no cash because all you did is you estimated how much something wore out. Okay? Then your accounts receivable. Now let's take a look. I'm going to put AR for accounts receivable. So your accounts receivable, I'm going to get a straight edge here. So your accounts receivable, let's take a look back here. In 2010, it was $128,000, and it dropped to $100,000 in 2011. Now what this means is you collected some of the accounts, you collected an amount equal to all of your sales plus 28,000 from last year. So it's the year where you collected. So what you need to do now is you need to increase the net income by 28,000 because from a cash basis, it's when you receive the cash that it makes the net income, right? So this decrease here, okay? Now, let's take a look at inventory. Now, inventory went from $216,400 in 2010 to $240,000 in 2011, so it increased. So when it increases, you deduct that. So here we have inventory increase. Now, by the way, up here was your accounts receivable decrease. So the increase, you deduct 23,600. Okay? And what it means from a cash standpoint, you understated your cost of goods sold. Okay? Now, let's take a look at some of the rest of these. Here's accounts payable. Now, accounts payable last year was $102,800. It increased to $121,600. That means that you have not paid for some of those expenses because accounts payable, what it is you incurred an expense, you get it in accounts payable. So you have not paid for that. Now the difference comes out to be $18,800. That's the amount of the increase. And it will increase your cash flow because you have not paid for that. Okay? And then, let's take a look at another. Down here you have income taxes payable. Now, last year it was $8,800, and it dropped to $8,200. Well, that means you paid off some of last year's. So that $600 will be cash out, and that will be income taxes payable. Now, plus this, plus this, minus this, plus this, minus that. There was an increase of cash of 166,600, okay? So this is your net income. Here's the cash you took in. So operations, you add this to this, so operations supplied 239,400 in cash. So the net cash provided from operating activities okay. Now I'm going to put up the printed copy. See what questions there are. We'll have a bit of a summary. And then we'll do some more practices. So, are there any questions? So to summarize, what we did now is there's three parts to the statement of cash flows. Cash flow from operating activities, that's the first part. Cash flow from investing activities, cash flow from financing activities. We only dealt with the top third, that top part. And we dealt with the accrual basis, we dealt with the indirect method. And what we did is we started out with the net income, which is on the accrual basis, and we converted it to the cash basis. So that's what we did here. Does that make sense? Now, let me do this. Let me put up these as guidelines for you. And then let's go ahead. I'll put those up in a minute, actually. And then why don't you guys do, let me get the, here it is. Why don't you guys do Quick Study 16-6. And you find that on page 665. Okay. Here's how it reads. So what it says is 16.6, that's 16.5. Here's 16.6. So what it says is, it has 3 years here, all right. So for each of the following separate cases, compute the cash flows from operating activities. The list includes the balance in the sheet accounts related. Okay, so let's take A. So what A says is, here's the net income. What do you do with, now next is depreciation expense. What do you do with that? Next is accounts receivable. It increased. What do you do with that? Inventory. Inventory decreased. Accounts payable increased. Accrued liabilities decreased. Okay? So how do you figure the net cash flow? So let me, first of all, does anybody, who doesn't have access to a book? Anybody? All right, I'll go ahead and take this down. Let me put these up here for your reference. And then, why don't you guys, and maybe go faster, feel free to get in teams if you want. Yeah, Gene?
Is that in the book?
Not in this format. It's in a bit of a different, it's in a different format.
Can you just tell us like what page it is?
Yeah, I just have to look for it. Yeah, sure, let me just take a look here.
Was it an increase, decrease? Yeah, I know, and then we got two that are all at once, and
Steve,
Yeah,
question for you.
all right.
Like on accounts receivable, it says increase, and then in parentheses decrease.
No, what it means is, what that says now is the accounts receivable, there's, yeah, when it has a parenthesis, it means that here's no parentheses. In this case, you have $80,000 more accounts receivable. When you compare it increased 80,000 over the course of the year.
Okay.
Here it decreased 8,000 over the course of the year. So we have the beginning of the year minus.
Oh, I see what
Yeah.
it's
So from the
saying.
beginning of the year to the end of the year, it increased. And then when it's in parentheses, from the beginning of the year to the end of the year, it decreased. So the parentheses tells you what direction it went. Gene, in answer to your question, it's not in the book, in this summary form. What I would do is I'd copy it. And then you want to come up here and take a picture with the camera?
I'll just copy it real quick.
It's up to you, okay, but it isn't in the book.
You do that person laugh.
No, do that. And by the way, this isn't in the book, you guys, so you may want to just jot this down. Or take a picture of whatever you're pushing.
Excuse me, just hold on right now a little bit, just so I can read what the heading is on it.
Sure.
Thank you.
So these are items on the income statement that do not affect your cash flows. Okay? And these are adjustment for changes in current assets and current liabilities.
Is this only for like the statement of cash flows when you do
It's only for the operating section of the statement of cash flows.
Okay.
So, yes, you're absolutely right, but it's even more restricted. Because all we're talking about are, so here's the deal. Current assets and current liabilities are operating reserve because they support operations, right? Accounts payable, for example, is, so if a bill shows up, it's an accounts payable, a bill is an expense. Okay?
Because you're paying off the liabilities. Yeah, so it's liabilities is a right.
It's like also doing the opposite.
And the reason I think that is because, you know, when I do that, so the way I did the reason, so from a cash basis, that's when it's counterintuitive, because you're saying that if I didn't receive the cash for tax, which is not true.
I have that one. It's like the same thing. I think.
Right, it's easy to see what goes up. On the cash basis, there's an expense review, right? So inventory comes in, paid for it, and shows the cost of goods sold. On the accrual, but if inventory shows up and you have to pay for it, then it technically should,
Because it should decrease.
yeah, because what happens is that, because you've understated cost of goods sold from a cash basis.
It's hard to wrap your head around. Yeah.
It is. In fact, now what you might do is that all current liabilities work in the same direction, and all current assets work in the same direction.
Okay.
And of course, for a mnemonic device, accounts receivable is easiest to see, accounts payable is easiest to see. So,
Just remember those.
and that will tell you. Yeah.
Are you doing this on the test?
Yeah, oh, yeah.
Okay. Memorize this.
You guys, this will be on the test.
What? But it's on the.
What you're doing now will be on the test. You should see the look of
Oh,
Liz's
that
face.
Yeah, gotcha, okay.
Just be forewarned.
Okay.
And by the way, you guys, you'll be glad you learned this. It's not just for the test. You'll say, yeah. I got you. But I emailed and that she not doing anything with it. So if you could get it as soon as possible.
What you get today?
Sure. You want to
Mine's 40.
Sure. In fact, let's do that. And then, you know, I'm going to be able to like this weekend.
It just starts down.
That's going down late.
The depreciation of that.
The inventory's decreased to 40,000, so 40,000.
Oh, it's 60, there's my problem.
But you're getting $40,000 for the inventory.
Angelica, you're not.
Oh, yeah, I got negative 40 for the depreciation.
Angelica,
It's 40,000.
you look different with
Is that
different
what
hair.
we make?
Yeah, you look different. Hey, listen, I got your email. Now, so let's, one thing, see what you said is it didn't make any sense.
The two questions you raised, I answered them, and I got one.
Let's just do this thing. I'll start putting this thing up right after class, we want to stop by.
Yeah, definitely, thank
And
you.
we'll take a look at that.
I appreciate it.
Sure. Sure, let me get the roll. Who has the roll? You guys, who needs to sign the roll? Thank you. All right, Nate? Good. Julius, here you are. All right. All right. Here you are.
Takes me a little longer to get to A. First one minus 20,000.
All right, Brandon, are you here?
Yeah.
Okay.
Monday, Wednesday.
Anybody else need to sign the roll? Yeah, you were here. I'll put it up in just 1 second. Let me give everybody a chance. If you read what's better, Junior, you're not here. Tiffany's not here,
Why?
Now, you guys ready for some answers? Who's ready for the answers? Antonio, you ready? All right.
So we have Monday after we come back from Thanksgiving.
Is there
16 is due,
Oh.
and we have a test
So anything that we don't make sway the numbers the wrong way. Maybe so like,
All right, you guys, let's just maybe put up the first one. Here's A. Now, are there any questions on this? Okay, are there any questions on that? Yeah, Brittany?
On the test, are we gonna have to like do this whole spot, or are you gonna be like, are you gonna show us depreciation and like state whether it's an increase or decrease, and we just have to decide if it needs to be added or deducted from the statement?
Well, I really couldn't tell you something like that, but just have you know how to work it. And so, no, and the deal is, here they tell you that it's an increase and decrease. On the other one, you had 2 years, so you could see whether it increased or decreased. You know, it's kind of a, just know if it increases or if it decreases, what do you do with it? Okay? All right, you guys doing okay on case A? All right, any questions? How about case B? Are there any questions? Okay. How about case C? Are there any questions? I can make it a little bit bigger. Any questions on that? All right, let's do exercise 16-4. And you find that on page 64 is on page 669. Now here's how it reads. Okay, here's 16-4. All right. So here's 16-4. Now, the Rodney Company's calendar year for 2011. The income states the following. So here they give you the net income, right? Okay. Then there's depreciation expense. Now, amortization works in the same way as depreciation for the same reason. Okay. There's a gain on a sale. All right. There's a gain on the sale of a current asset. Okay. So there's a gain on the sale of plant asset for $7,000. So don't forget, you're going to cancel out depreciation. You're going to cancel out the gain on the sale of the asset. Okay. And it's because they're non-cash. They're items in the income statement that don't affect the cash flow. All right. Then they talk about current assets and current liabilities. They tell you accounts receivable decrease, merchandise and inventory increase. And of course, here's the pattern they follow. Okay. So you adjust for them. Okay. Use the indirect method. So is everybody okay with that? So I'm going to go ahead and take this down, because everybody has access to a book. Let me put this up, so if you guys want something to refer to. I'll put up the answers in a minute. Ryan, how you doing? You subtract. And the reason you do is because there was no cash. All you said is when I made this sale, right? When you did it on the accrual basis, gain on sale. So what you did is you took a look at the book value, You took the money you paid in, and so you took in more money than the book value. That really, on accrual accounting, it is a concern, right?
Yeah.
And it's because accrual accounting worried about depreciation. Cash accounting doesn't worry about it, right? So what you want to do is you want to cancel out depreciation, cancel out amortization, cancel out depletion, cancel out losses by adding them back, subtract gains, like it's better. So you just cancel them out. Okay. Oh, sure. Brittany, you doing good? I'll be right with you, Justin. Yeah. Well, no, all you cancel them out. And the reason you cancel them out is because there was no cash involved. So like depreciation, all you said is, I estimate that the car wore out this amount. Well, you didn't write a check for whatever, you just estimated. So that because there's no cash in that expense, it's only your estimation, you cancel it out. So you add it back in, so you cancel it out. You cancel out depreciation, you cancel out amortization, you cancel out depletion, the top three, by adding it back, you just cancel them out. And then you do the same with losses, you add the losses back, you cancel it out, and you subtract the gains.
Oh, and also the losses and gains, because we're already tracked in cash, like he's already tracked that gain.
That's a possibility.
So that's the way we do it, right, cash was here, and then we have whatever and then we go.
What it is that you
Yeah,
because all you're doing is out here, these actual actions. And so with gains and losses, in this
we've already
case,
added it to cash already.
that's all you care about, is the gain and the loss is not relevant. Hey, Justin, thank you for waiting, I appreciate that. What, excuse me, what do you got?
Keep them pretty secret, so they won't use ways.
Yeah, exactly. Well, what you're doing is you're affecting some of last year's financial season with this year. So you're going to call it in from a cash standpoint is when you receive the cash. Okay, so if you receive the cash this year, it shows up as net income this year. Versus
It should be.
because this is this year's sale. Yeah. And the reason you don't is because what you're doing now is you're counting some of last year's sales as income for this year, right?
Why does it gain on sale and assets as reduction?
Because there's no cash, you're canceling it out. So what you're doing here, you see the gain, you cancel it. And it's because it's an accrual concern, it's not a cash concern.
You're not actually getting given out, what's actually going on?
Well, what you did is, when you sold the equipment, down in the investment section, we call it cash in. And that's all that matters. All that matters was the cash
And
in.
next year.
So on the investment section, when you sold it, it was cash in. You bought it, it was cash out. That's all that matters. Gains or losses aren't a cash concern.
Yeah.
And I hope I'm giving you a good answer there, but it's, you see what it is all that matters on the cash basis is cash in and cash out, right? So when you sold something, the only cash you receive is all you're going to count. Gains, losses, and all that don't matter. Okay. All right. Yeah. Just before I move on, I might, anybody I'll be with you in a second, I might give you a good answer.
Yeah.
Okay, now what it would do is, so, and when we get investments in the financing, did you always check back with you, make sure? But again, all that matters is cash in and cash out. Gains, losses, they're just accounting. From a cash basis, that's the accounting. Yeah, okay.
Yeah, I have a little trouble figuring out why prepaid expenses is adjusted.
Well, what this is an increase.
It's not actually.
It is, and that's why you have to get it out. So prepaid expenses won't show up on the income statement, on the accrual basis. On the cash basis, even though you're paying it out, it will show up. That's where you subtract.
Okay, so yeah, I think, so it doesn't show up.
But it will show up on the cash basis.
Okay.
You didn't get it.
All right, thanks.
You guys, are you guys ready for the answers? No. No? All right, okay.
There's a
If it was prepaid revenue, now that would prepaid revenue, that, actually, prepaid, so that would be the liability mean? So prepaid revenue would be unearned revenue. And that will be current liability, and so it will work like current liability. So prepaid revenue, the name for that is unearned revenue. We're talking about increasing, right? So if unearned revenue increases, yeah.
Any help? I don't
All
want
right. Hey, you guys, I hear a lot of voices. And one reason I say it, you guys ready for answers? Is that what we want?
Yes.
All right. Gene, I'm going to put up these answers and then let me come and see what your question is.
Thank you.
Okay? $2 off. Oh, shit. Yeah.
Just kidding.
It's
So close, it's so
but we're adding so.
But, and which one you talking about? Now, if accounts receivable increases.
See, I'm open in 2 years.
No, can you show me Okay, if it decreased, you add it. And so, here's what happens, you see over here, now the reason you add it, now here's what happens. On the cash basis, when you receive the cash, it's a sale, right? So if it decreases from year, from beginning of the year, becomes receivable. Because you got all of these.
So they actually
Plus some of that.
you add.
So you want to add it because
Yeah.
it's
So you're right, we should So
and not only that, it's what
I did add it, yeah,
and the reason is
Don't ignore that one.
but it was definitely so this I'm sorry.
So if we choose not to pay for it, but it was like split until the
Are you checking the Wednesday?
You have to figure out how much it was going to be. Saving now is the interest. You're saving more.
I always thought what is like a month.
Hey, listen, you guys, let's do 16-6, page 669. So let's do another one. Now, are there any questions on this? Now, by the way, let me see if this is helpful. Don't forget, there's cash accounting and accrual accounting, right? So what we're doing here is we're converting the net income on the accrual basis to the cash basis. So let me see if this story is helpful. When I was in graduate school, you know, some of these people live, eat, and sleep their discipline, right? So I had the accounting professor, he was a PhD to the core. So listen, he showed up one time and he says, accrual accounting is bullshit. And he wasn't kidding. And his point being that because you have things like depreciation, amortization, and all that, there's too many estimations in it to make it accurate. From his standpoint, the only thing that mattered was cash accounting. And on this, he had these jowls, he literally turned purple, and he says, accrual accounting, it's bullshit. And he wasn't kidding, right? So what we're doing here is we're getting this accrual accounting, which has a lot of estimates in it, and we're converting it to pure cash. Because the only thing because cash is cash, everything else is accounting. You know what I mean?
I thought it was bullshit.
Well, yeah, cash is, no, from his standpoint, and he wasn't kidding, he was purple, right? He put the court, cash is cash and everything else is bullshit.
Would that be
Now-
on the test?
No, I
I know the answer to that one.
excuse me, and you guys don't quote me on that. Oh, damn, that camera's on. But all I need to say, all I need to say is that from his standpoint, this is the only thing that mattered and everything else was fluff. And I'm just hoping I'm clarifying what's going on here is when I present that example, right? So when you talk in terms of gains on sale and amortization, depreciation, you're talking about estimations. From his standpoint, you're talking about machinations. Okay, so again, I don't mean to be indelicate. All I mean to say is that that's what's going on here. All that matters from his standpoint was this. And so you converted the, as you know, does that make sense?
So one is theory, the other's fact.
Yeah, it's a good way of putting it. And he wasn't kidding. If you saw that guy, you know, you'd think he was about to have a heart attack or something. All right, so you guys, you want to practice one more? We'll have a break.
Yeah.
Okay.
What are we doing?
16.6, 660, right? Yeah. Don't worry about the dress. And the reason is because so few companies use it, you'll probably never see it. Just because so few companies using it. But the reason it's included is because you can see what's going on. It's more fair, because it has a tremendous following. Now, were you here last class? Okay, yeah, because what they're saying is, when I went to the American Accounting Association, those guys were saying, we really should use the direct method because it's a better way to do it. It's just that nobody's going to make the change. Okay. No, Julie, not in this class, just because you'll never see it. Now, the reason it was included is because, you know, it's easier to understand. Okay.
So when's our next test, on 15, 16, 17?
Well, let me just check. Yeah, I think it's a week from, it's on,
A week from Monday?
yeah, it's on a Monday, and it's the Monday, the last week of school, so it's I think it's December 1st, I think, but let me just double check. So, so the deal is
December 2nd?
December 2nd.
And we're gonna study the hour before?
Exactly,
Like we
so
normally do?
the first hour we'll have the study guide, second hour we have the test, and then I'll get them back to you on the 4th, which is the last day of class, and I'll also collect your project from that day. Probably the version of the 801. and it'll be chapter 16, because much of this is just a matter of practice. And often if you just memorize this and work with it, after a while you see that that's why they're doing it. But if you just memorize it and you work with it, then it'll work for you. Exactly. And so we just go with it. Now, Justin, did you get that answer to your question?
I actually just now, I understood.
And did that little example help about the professor?
Oh, yeah, it did help.
Because, you know, it's the idea.
I think I actually might have been looking at it.
Yeah, because what it is the advocates of, you know, what they're saying, they say that, listen, enough of this, you know, estimation and all that, heck with it. All that matters is cash. If you don't get paid, you know what I mean, that's all that matters. So let's convert this to what matters, cash. And that's the point. So cancel out depreciation, cancel out amortization, cancel out gains, cancel out losses, because it's just hot air. No. And whatever you guys do now, don't tell, like you take a class for professional, don't tell them this, right?
The best part, when he said, oh, damn, that thing's on.
That'll be memorable.
YouTube broadcast yourself.
I don't know, this is all looked up.
Oh, wait, this is
Yeah, these are all the.
estimated portion of salaries,
You don't do
This is actually.
Okay, so appreciation.
Oh, I needed that.
You did get that, right?
Salary.
And interest.
Okay, so salary is
Self-interest,
actually-
I'll look at interest in the awards over
We're trying to get
I
the
know there's
cash. We only added things that were not cash transactions. So that was the top, right? The amortization, the depreciation,
add in your depreciation expense, when you work with the subtract your fees. You can see it right here, both been subtracted, and the gain has been added automatically.
Or overestimation or
Yeah, it wasn't.
Add that in.
So everywhere,
They were already subtracted out, so I added them back in.
well, more what it is your book value.
I didn't see any accounts receivable.
Because the book value is how much you paid for it, minus accumulated depreciation.
Anything above 60 years old.
And then when you sell it, now if you sell it at a gain, what that says, when you sell it at a gain, it means that, sell it, let me stop. You sell it at a gain, it means you declared too much depreciation. If you declare it a loss, it means you have more depreciation. The point of the matter is, it's all depreciation estimation. So those gains are, that makes sense. Now, what does matter, let me kind of take it to the next step, all that matters is if you look down at that investment section, that's the actual cash receipts, and the actual cash receipts that are sold. That's what shows up. And it's all that matters. All right, you got your reverse answers? Okay. Scott, you read your answers? Yes, you guys want to take a minute? See what, let me see what questions there are.
Right about depreciation.
Yeah, well, just one second, let me kind of. Well, actually.
No, I realize. I mean, if we got it the right
All right, and so you guys, should we take our first 10-minute break? Keep an eye on your watches, I'll set my clock here. I'll try to start in 10 minutes. See what questions are. Any questions? 10-minute break? How you doing? Yeah, it is. Yeah, because that's all you're doing, yeah. Yeah, and you should have seen that, because it looked like he was just I don't know what, something happened before class, and he was serious. I just can't see it myself, because you know, you buy a building, cash out, and all the buildings and expense in the area you buy. I just don't see how, you know, I have no idea how things that would work. But his point being, there's too many estimations in these bases, and with all this, it's just too far out of reality.
So 9 was 11 is and then 10 was before 9, correct? Yes. Okay, so I just finished 8, I still have 9, then I just do 9.
5, 2, 5, 2.
I finished 10.